Hi, I'm the College Money Mom. Federal student loans can be complicated. There are two kinds of loans that most undergraduate student borrowers may be eligible for: subsidized loans and unsubsidized loans. These two loans have a lot in common. They both charge fees of about 1% of the loan amount. The interest rate for each type of loan is the same and is fixed for the life of the loan. Both loan programs put the schools in charge of dispersing the funds. Most schools disperse the loan money in two equal parts, each at the beginning of a semester. Both loans require that the borrower sign the same promissory note, which spells out the borrower's responsibility to repay their loans. Students may be eligible to borrow new loans under the same promissory note each school year. Both loans give students a 6-month grace period before repayment must begin. Borrowers of both types of loans may be eligible for the same federal repayment programs. The main difference between federal subsidized and unsubsidized loans is that the government pays the interest costs on the subsidized loans while the undergraduate borrower is still in school at least half time and during the 6-month grace period before repayment starts. This is not the case for unsubsidized loans. Interest is owed from the very first day the loan is disbursed, usually at the beginning of a semester. Student borrowers of unsubsidized loans can choose to pay back the interest right from the beginning if they wish, or they can choose to allow the interest to pile up or accrue until repayment starts. Unpaid accrued interest will then be added to the original amount. This is called capitalization. In times of low interest rates, capitalization may not be as huge a problem, but if future rates for new loans go way up, avoiding capitalization could become increasingly important. Here's a formula for how daily interest is figured on student loans. The amount of the loan times the interest rate divided by 365 days equals the cost of interest per day for that loan. In this example, the amount of this unsubsidized loan is $5,000. It is multiplied by the interest rate of 3.8%. Once divided by 365 days, the result is 52 cents per day. So, if a student takes out this federal unsubsidized loan in his freshman year, and assuming he graduates in 4 years and has a 6-month grace period before repayment starts, there will be 1,550 days of interest at 52 cents a day. That's a total of $806 of accrued interest. If the student does not pay that accrued interest off before repayment starts, it will be added to that loan. Now, the original $5,000 loan will be a $5,806 loan. And as repayment begins, the student borrower will be making monthly payments of principal and interest on that higher loan amount. If that same student takes out a loan for the same amount of money each remaining year in college, and if the interest rate should happen to stay about the same for this example, here's what the entire accrued interest could stack up to be: $2,085, which when added to the $20,000 borrowed becomes $22,085 to be paid back beginning on the repayment start date. I hope this explanation has been helpful. I have included links to further information on this topic just below this video. Please subscribe to this channel and be sure to like me on Facebook. Thanks for watching. Bye-bye.